Several major retailers reporting quarterly results this week. Joining us now with a look at some emerging trends in the sector, Simeon Siegel, Managing Director and Senior Analyst at BMO Capital Markets. Simeon, great to have you with us.
Morning.
Home Depot, is that a read-through to any of the companies that you cover?
Yes and no. Always. Right. I think what is so important, we're talking about consumer here. This is not financials, not biotech. This is very concrete. We all do it. And the problem with that is we all mistake the story. There's this huge negative cloud. And I get it, right? There's no question, macro, consumer. But there are companies that are winning and there are companies that are losing. And I think we're losing that point. And so I think it behooves every company to recognize that there are companies selling the same thing to the same people with completely different results, which means you need to execute, you need to put out product. And so you look at a result and you say, okay, look, we're clearly getting a signal that the environment is not what it was when it was great during stimulus. But I assure you companies are winning.
Right. I mean, I think the most obvious example would be a Lulu and a Nike versus an Alo On, which just reported. And so it's the same consumer, different picture, though.
The exact same consumer. So you and I talked about this a little bit ago, where all the luxury companies came out, and that was this huge negative harbinger, whereas, okay, you know what? Even luxury is going, because LVMH and Kering, Gucci are telling us there's a problem. 2 weeks later, Hermes and Prada told us there wasn't. And so all of a sudden, we see Nike and Adi and Lulu telling us, hey, you know what? Maybe there's a little bit of a problem, and we've got Hoka and On telling us it's not. The same thing happens in denim. The same thing happens in underwear. During COVID, there was no reason to be a winner or a loser. There was stimulus or there wasn't. But that's not how companies work. Companies are supposed to share. They're supposed to steal. That's what market share means. And that's what we're seeing now. But what's interesting is the largest companies, told LVMH, Nike, they're the ones seeing the pressure. So now we read that as, oh, everyone is seeing pressure. There's a problem. No one's spending anymore. Revenues across my group right now are averaging up 3%. It's not 10, but it's not down.
You take a look at the activism that had happened at Starbucks. With great results, or seemingly, at least for now, up 25% yesterday's session. Why not for a Lulu? Why not for a Nike? Or is that? Do you think they are ripe for that?
Who isn't? No, I think yesterday I had so many questions that immediately said, because On reported earnings yesterday, is On driving Nike up mid-single digits? And it very quickly became, oh, that's Starbucks. And so the amount of people the stories that bunch Starbucks, Estee, and Nike together as these multinational consumer companies that were dependent on China and now have challenges in China, that had U.S. now. There's so many similarities there where you have to say, listen, it's hard to be a manager in an environment where being a good manager is important. And so there were a lot of questions that flowed through. I'm not going to say all of a sudden Nike's getting an activist. I mean, it's just interesting to see. Sure. But I think Starbucks is probably their own conversation. But I think every company that we're talking about in the lagging category needs to look at the winners in their categories and say, what are we not doing? When everyone's doing great, it's easy to let management have the pass. We've also had a lot of conversations around Nike D2C versus wholesale strategy. There's finally, 3 years ago, my team wrote a report saying, why are you abandoning your partners?
Right.
They're the reason you are where you were.
But, I mean, to be fair, they were lauded for their DTC strategy. It was like higher margin, it's great, they're cutting out the middleman, people love it. And now it's like, no. That wasn't the way to go. You need your Foot Lockers and Macy's of the world.
Not to pick on them, but Peloton was also lauded. There's a lot of companies that get lauded. In consumer, it's so easy to see things we love, and it's so obvious to say, well, cut out the middleman and you'll make more money.
But is that the problem, or is the problem the product?
The product is selling. There's $50 billion of product. So, I think to your point, there's no question the innovation is this big question mark. But people like us challenge the innovation, whereas people that are going into stores spending $50 billion are saying, you know what, Nike still stands for something. But I think to your point, I think they got so obsessed with where they were selling versus what they were selling that they allowed for a Hoka and an On to come in. And so they do need to improve the product. But recognizing that you don't eliminate the middleman, you become the middleman, was something that I think needs to, we're coming to grips with that. 3 years ago, that report was wildly contrarian. It's not anymore. Right. But I think understanding who you are, product is the core of who you are. And so you're right. You need to be maniacally focused on what you're selling as opposed to where you're selling.